and we'll do Mr. Microphone, and we'll be ready to go.
Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld.com, PSW, nor its affiliates, nor any of the respective officers. Personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. PSW provides education and training services that are meant to teach you to the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on a specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any loss you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone.
Okay, fantastic. How's it going, guys? So look what's happening. We're actually getting profit in gasoline for a change. Where is it? Oh, you're kidding me. Where is this thing? Oh, it's broken. I have to restart this. Hold on. Oh, everything was going so well, too. Anyway, well, gasoline's selling off, and it just dropped down to about 180, which is a nice little profit from where we started, because we've been adding to them on the way up. Oh, so I can't get this restarted. We're going to have problems. What are you doing? All right. Shoot. Hang on a minute. I'm going to have to pause the sharing. Hold on. All right. Let's hope this works right. Oh, good. Okay. Seems okay. You guys see my Thinkorswim screen? Yes, no, whoops, wait. Is that a yes to the Thinkorswim screen? I wish there was timestamps on it. Okay. All right. Where is it? Oh, there it goes. Okay, fantastic. So the market split back up. That's interesting. Oil really took a downturn. It flew all the way up to 57.92 and plunged back down to 56.64. And gasoline, as you can see here, has plunged down to 181, which means, dare I look, for the first time in 2 weeks, it's green. There it is. Look at that. It's $1,200 today. I added a couple before, but then I of course sold off. I sold on the dip. Got back to zero. Now I'm even. So this is actually my basic even point. It's about not what it says here, 183, but probably right about 181 on the even. And I'm still with 4 open short contracts, still expecting a dip of some kind. The Dow is back to where we shorted it the other day, but it's on the way up. You don't want to really short something when it's going up. You want to short it when it's going down. So we'll keep an eye on that and see how it goes. The other indexes are plowing higher, so I don't know what happened or who said what. I wasn't paying attention just now. We'll have to see. Natural gas, nice big pump for us. Dollar kind of flat. Gold up a bit. Silver up a bit. Silver, anytime silver goes below 17, it's time to start thinking about buying it at this point. and coffee more or less flat. Okay, so that's where we are. That's the excitement, and I want to look at the oil inventory report for sure. And you guys let me know what else is on the agenda. But let's take a look at the API report, the petroleum. Oops, my cap lock. So I'll put something that's important. Google doesn't care. Google is so smart. Getting smarter every day, and soon it will take over the world and kill us all. But other than that, it's really good. Very useful. Okay, here we go. 1 o'clock, PDF. And control bigger, bigger, bigger. Great. All right, so we had a surprise because the API report showed a build in gasoline, and here we had a draw in gasoline, so it really was a flip. So this is a healthier report. The net was import, blah, blah, blah. Okay, gasoline inventories decreased $4 million. It's still a healthy decrease, but are in the middle of the average range. Both finished gasoline and blending components, blah, 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 lower half. Somewhere it says something like distillate. Commercial crude decreased by 2 million barrels. This is a strong report for these guys. This is the right report, right? Okay. No, this isn't the right report. What is this? Why does it say October 27th? What happened? Is this saying how smart Google was to give a totally wrong report? What's going on here? For the week, previous issues, November 8th. Go to November 8th. So it says October 27th. Wow, interesting. Let's try this again from scratch. Petroleum. Weekly Petroleum States Report, November 8th. Wrong report. Son of a bitch. You think they got their clocks messed up? Could that possibly be the reason? Like maybe they didn't adjust for the time and it's not releasing properly? What was this morning's report looking like? November 3rd. Well, that one's, yeah, I bet there's something wrong with their clock. We might have to wait an hour to get the PDF. All right, well, that's a little disappointing because I really did want to take a look at that and see what's going on. Somebody, you know what, that sucks because somebody got the information and it wasn't good though, because that's why, I mean, such a drastic sell-off in oil, you have to believe something must have gone wrong. Oh, look, we were long on oil. What is this? Oh, this isn't even this week. Ugh. This Wednesday. That was last Wednesday when we were long on silver. There it is. Okay. So oil was up 2.2 million barrels. Gasoline had a draw, though, and distillates had a draw. So that's a pretty significant draw. Last week it was 4 million, now 3.3. That's still a pretty good draw. And last week there was barely a draw in distillates, and we got a big draw now. So something's going on, and unfortunately we have no idea what that is, and we have no way to find out. So that's where that stands. Kind of hopeless feeling. You wish NG would drop like oil. I sure don't. I have longs. Why does he wish that? That's mean. You're being mean to me. Natural gas is, whoa, that's nicely up, huh? So we're playing the really long ones, though, the NGV8, right? Is that what we're playing on these? So where is NGV8? Oh, there it is, right there. Oh, it's up at 308. Okay, good. So if we look at that on the active box, NGV8. Oh, look at that. Well, we're talking, we're making money, right? Now it's 180 and a bit. It's been so long since I made money on gasoline, I'm not sure what to do. All right, so here we're up $2,000 on 4 contracts, up about $500 a contract. And it's just drifting along. I expect these to go much higher, so I'm not sure if this is a big enough spike where I'd want to cash them out. It is infinitely more profitable, though, to play the channel on natural gas than to just, be a dumbass about it. So I guess, this is probably a spot that we should take some money, because we can always get back in if it breaks over that line at 320. Because 320 rejected, 320 rejected. So if 320 is rejected here and we're all the way back down there, we're going to feel like dumbasses, right? So I would say take the profits here and in the very least lighten up. So let's practice what I preach, and I'm going to go, we're long, so we got to sell. I'm going to sell one, and I'm going to sell one more. That failed a little too easily. So now I got 2 off the table, and if it breaks back below 3, well, not 3, it's 309. Well, you see, these are slower to come back than the others. I'm going to get out of this trade. I'm going to take 2,000 and run. So my profit for the day, of course. Now that they're gone, it's only showing me the profit for the day, but I know I made $2,000, so I'm happy with that. You got to be happy making $2,000 a day. There's 200 days a year to trade. That's $400,000. You can't be happy making $400,000 or at a rate of $400,000. It's a problem a lot of traders have. Like you always want to make more, obviously, but you've got to learn to lock in the $1,000 here and the $1,000 there and the $500 there. And if you can just lock in $2,000 worth of gains a day, you're going to be doing $500,000 a year in profit. You just got to learn to lock it in. And you lock in the winners, you work on the losers, and try to keep your losing percentage low, and everything will work out just fine. Now here on gasoline, we want to see what oil is doing. So we're done with natural gas for now. Hopefully they'll pull back. And if they don't, I'm going to pick them up again when NG, which just got rejected here, when NG goes back over 320, I'll be happy to pick it up again on the longer NG. See, the NGV contracts are dragging by quite a lot. They're way down at 308. But I like the longer-term contracts because I don't want the volatility. If it does go down 10 cents instead of up 10 cents, I don't want to get burned that badly. In fact, I want a chance to add more. As it stands, it went pretty much straight up from where we came in, so we haven't really been adding more. And we're just waiting for those long contracts to creep up. But if this guy comes back down again and we test $3, which is way down here, if we can test $3 again on the front month NGs, I'll buy these, and I'll buy the NGVs again. Meanwhile, where were we on the oil? See, gasoline. So I was going to look at oil, CL, and see where we're on now. Now we're down getting by 56.50, which is going to be support. You know it's going to bounce. So why should I lose money on the bounce? Why should I wait? So let's we are short for. We want to buy back as cheaply as possible. So we'll put an offer in over here and see if it fills. And then look what happens. Jump right back up over. They're like, oh, a customer. But meanwhile, I'm the only offer. My contract here, it filled. See? My contract was the only offer. So now I'm going to make another one. That filled very quickly, so I think it's going a bit lower. Still, I'm going to clean out of my gasoline. Wow, that one filled immediately. Now I'm worried I'm getting out too early. There's my last one. I may be the only person offering to buy on the gasoline. The only real person. You just probably fake to try and drive it back up now. So I don't care if I'm still short one contract. That's no big. That just tells me when I want to double down now. Oh, and I filled, so I'm out. Now, I don't like the fact that I filled, though, because it means that really I was literally the only person buying gasoline. And that means that these guys are in big trouble, the people trying to sell. So I'm not sure we're going to get the bounce we expect, so we'll keep an eye on it. But again, I'm not life or death on gasoline. We just made for the day, $1,500. I have an overall profit now on the position. I'm done. I'm thrilled. I am thrilled to be out of this stupid thing. So now I got 1,000 here and a couple of thousand here. That's like 3,000-4,000 for the day. I'm done. What should I do? And why would I want to look for something else to trade? Unless there's something so obvious that it has to be traded, why do I want to trade anymore when I'm up a few $1,000s? That's another thing people need to learn to do is walk away. Just like it's just like poker or anything else. In poker, people play and they win. And then there's a thing called tilt because they keep playing and then they lose everything they won and then they lose the money they came with and then they go into their pocket and they lose more money. Why? Because they weren't satisfied with what they won. And you don't recognize the fact that things sometimes go your way and sometimes don't go your way. And when things go your way, if you can't learn to take a profit on the things that go your way, then you're never going to win. You have to have a limit in your play. You have to have the common sense to take something off the table when you're winning. You don't need to get 100% of every move because there's another move to make every day. There's always going to be another move that you can play. I mean, you guys see, these charts, I don't think, they probably haven't changed much. Or maybe at all year long. I watch the Dow, the S&P, the NASDAQ, the Russell, oil, gasoline, natural gas, the Nikkei, dollar, gold, silver, and coffee. And I used to watch copper, but I like coffee better than copper now. That's what I watch. And almost any time I sit down, I find one of them in a spot where I'm willing to play it. I know them. There's only 12 positions. There's only 12 positions, and 4 of them are indexes. They're all pretty much the same. So I know them all like the back of my hand, and I know exactly where they should be at any given time. So whenever there's a discrepancy, I jump on it. So at the moment, the biggest discrepancy right now is the Russell was too short. And it's still too short. If these guys keep popping up, then the Russell is too low, and it's probably going to have a nice pop. So if I was going to play anything right now, I'd play the Russell long at 14765. Oh, it's right there, 14765. Predicated on this, 23.5 on the Dow, which, boom, there it goes. Predicated on 25.90 on the S&P, which were just a tiny bit below. And predicated on 63.35, I would say, on the NASDAQ. And not that that's a significant number, but just that that's where I'm lining up. So if I'm going to make a long play, I want to see the other guys getting over their little levels that they're at now. So the Dow's staying over. The S&P isn't making it, though, so it's a no play. I just wait. And 9 out of 10 times I look at a setup, it's a no play. 9 out of 10 times I look at these screens, I don't play it. But you know what? I look at them 20 times a day. So a couple of times a day, I do play it. I see a setup, and I'm like, oh, that one seems interesting. And then the trick after that is to make sure you win more money than you lose. If you can get that right, you'll be in great shape. And that all goes to whether or not you have a good stopping discipline. And we were just talking about that in chat. And you guys see it all the time. I don't stop out because I'm working. I can't stare at the screen all day. So I'm talking to people in chat. So instead of stopping out, I'll scale in and scale out of position, which means I'm more prone to taking an entry where I have a real strong fundamental sense that something's going a certain way. So in this case, for the Russell, I don't have a fundamental sense the Russell's going up. It's my biggest hedge down, in fact. So I would only be playing it for a bounce while I'm looking at it. I would never walk away from that trade or look to add to it. So I don't have long conviction on the Russell. But as a trade right now, it's a good trade if the other guys go up. And now the Dow is up over, and we're still waiting for the S&P to confirm. But if the S&P confirms, I'll be willing to do that trade with you guys. Now, gasoline, I have conviction it's going to go down. So why did I just get out of it? I got out of it because it made money, and it's probably going to bounce. And if it does bounce, then I can get back in at a higher price. And meanwhile, I cashed out the lowest price. If it does go lower, if it breaks below this channel here, and the oil breaks below this channel here, then I'll pick one of those guys and short them, probably oil, because oil had a worse report than gasoline did this morning. So each one, I've got a logic for why I'd be doing something. When silver or gold are low, I play them. When they're high, I don't play them short. I only care when they're low. I want to play them low. And the dollar has a channel, which I like to play within the channel. I don't generally short the dollar. I like to go long when it's low. And coffee, I constantly pick it up right about here at 128. This is the H contract for next year. So I always pick it up at like 128, and then I get out about 130 here. Like, this is where it stops. So I just wait, and it comes back and back. I don't think I'm playing at the moment because I think that I got out here and I didn't get back in today because I'm busy. I'm like running here. I got the webinar, so I didn't get back in. But that was a setup today. If I was paying attention, I hit 130. Well, I'm sorry, not 130. It's 127 something. It's below 128, and I'm getting a run back to 130. So I'm happy. But this is like, it's not coincidental that just you guys come in Wednesday at 1 o'clock and there's like setups. There's setups all the time. You just got to look at them. You just got to have, but you have to have those basic premises. And what we do at Phil Stock World is we have something we call the big chart. And the important part of the big chart is here. That doesn't work well. Can't highlight. But the important part of the big chart is this thing. Oh, that doesn't work. It's all one picture. And these are just simply the levels using our 5% rule that we've determined where the indexes should be. Then this visualizes where those levels are, and that tells us who's up too much, who's up too little, so on and so forth. So the Russell, we were talking this morning, is breaking down here. And if it continues to break down and it hits this blue line at 1469.14, this is the Russell, not the Russell futures, but they're close enough that you can look at both. So below 1470, which we're at 1477 now, below 1470, right here where it's bouncing, basically that's the 50-day moving average. You do not want to go below that line. That's very, very bad for the index. And that would be very bearish. Doesn't matter that the other indexes are up. If this one starts failing its 200 or 50-day moving average, then you can expect at least one of the other indexes to start following. Now, aside from that, the NYSE never even got above its must-hold line. So the NYSE is nowhere, and that's the broadest index, which includes all these other stocks. All these other indexes are distorted by just a few little stocks that can drive it up. We talk about the Dow all the time. We talk about the NASDAQ. The S&P even has 10 stocks of like 40% of the index. And the Russell has key stocks that can move the whole index. So these three, especially low, it just takes a few stocks to move the whole index up. So when they completely disagree with the NYSE, you have to default to saying, well, the NYSE includes all those stocks, but it also includes all the other stocks that are out there, basically. It's pretty much every single stock, other than some NASDAQ listings. And that tells you where the really broad market is headed. And the really broad market has flatlined since mid-October. So this move up, and this move up, and this move up, which is crazy on the NASDAQ, are all not a broad market rally. They're just off by themselves, it's like running up. We'll see what happens there. He's breaking into my house. Hang on a second. And then he was tragically killed. Oh, yeah. That's just my daughter's friend. All right. So, where are we? Oh, yeah. So anyway, so we're not seeing super strength in the market, but we're also not seeing tremendous weakness. I mean, the NYSE moved right along with everything else until recently, and this recently is when we started getting a little bit more cash. This is what 529 thing. So this is where I said enough is enough. On this ridiculous pop, I decided to just cash out my kids' college plans and probably until January earnings, would be the next time I'm likely to get back in. If we're still up and we're still flying in, then fine, I'll be happy to get back in. But right now, it's too dicey looking to me. And let's take a look at the indexes and see how they move. I mean, here's a longer range view. Here's the election, and here's what's gone on so far. And notice that 15,000 line, though, we're grinding to a halt. We came from the 1,000 line, 50% up to the 15,000 line. No real pullback, and the 5% rule says we have a 50% gain. So we should have a 10% retrace at least. That's 150 points down to here, 1350. And a 20% retrace would be another 150 points all the way to 1,200. So that's how much of a pullback we could still have. All right, about that 300 points. 1,500. No, not 300. Sorry, bad math. So the run is 500 points. 20% is 1,000. I'm sorry. It'd be 1,400 would be the first retrace. 13 would be the second. So 13 is what's got a hold on the Russell. And you can actually see it's interesting how it's like very much of a line going up. On the way up, it was very much of a line. So this 1,300 line is critical on the Russell. And that's where we expect to see it. We expect to see a pullback at least to 14, possibly to 13. Now, if you do the math, and we say, well, we're certainly going to see 14, so that's going to be 10 divided by 150 is 6.6%. Now, 6.6% times 3 is 20%. Wow, that worked out. So on the ETF, on TZA, we're going to see a 20% pop from where we are now. And where are we now? Ooh, what a treat. I got stock charts working. See, I'm trying to figure out the password thing. So here's TZA. And actually, look at it go since yesterday. So it's popping already. But TZA from a base of, say, 1350, and then you add 20% to that, is going to be 270, right? So 270, so it's like 3 would be 1650. So in fact, right here, basically. So that's our target for TZA. We expect at least that kind of move in the Russell. I'm sorry, in the ultra short of the Russell. And we can make a hell of a lot of money on that with hedges. And we do. We have our hedges in place on TZA. But that's the pullback we're expecting between now and January. And it may not happen until into January because we talked about that last week of the tax selling issue. That people want to hold on to their gains if they can into the end of the year because they're hoping next year they'll be taxed at a lower rate. Now, there's a problem, though. If the Republicans don't pass this tax bill and they for sure put it off until next year, that means everybody who's holding these gains is going to be like, oh, screw it then. We don't need to hold these anymore. Because it won't make a difference if they do it next year because it'll be too late. And nobody thinks the market's going to stay up for an entire year. So it'll be like every man for himself as soon as that happens. So we got that to look forward to. All right, now, there must be some questions. Let's take a look. No, not really. All right. So I can buy at your levels. My level's not that big, though. I mean, if you look at the natural gas thingamajiggy. The natural gas thingamajiggy. All right. Here's the channel. I mean, you say I wish, but I wish it's basically this. It's like when it's at 290, we buy it. 290 is a buy. 315 is a sell. Or whatever this is. 3. Okay, if that's 3, it's like this is like those IQ test things, right? If that's 3 and that's 340, what do you think that is? That's 320. All right, so yeah, about 315-ish is a sell. Anyway, so 290 buy, 315 sell. It's a 15-cent channel, which pays $1,500 per contract up and down. That's it. Not hard. Silver's got a pretty good channel too. Silver's channel, anytime we're down in 1675-ish, we like to buy it, and it's a little trickier, but only trickier if you don't stop out. I mean, basically, if it goes down, if If it's on the way up through 1675, definitely it's a buy. If it's on the way down, not definitely a buy. So don't, you got to bounce here, but you got to be careful. If it's here, you want to see it going up, not down. If it's coming down, you have tight stop to get out. Coming back up, you play it. It touches 17. 25 cents on silver is a big move. That's like $12.50 a contract. Or we can play, and of course we can play again over the 17 line. It's another good place to play it. Under the 17 line, get out. That's an obvious stopping point. Then back here, then 1675, you get back in. In this case, there's no stopping out. You go over to 1750 for a massive gain, whatever 75 times 50 is, 4,000 something bucks. You just got to identify a channel, and it's not so much just visually identifying a channel as having a fundamental preference to how you're playing it. So like coffee. Oh, and I posted 2 really good articles about the coffee crop this weekend or something like that, I think it was. I don't know, I was away for the weekend, so I'm very confused about when I did things. But there were 2 really good articles about coffee, both of them saying, like, look, global warming is completely screwing up the coffee crop. And it's the same premise I had a year ago when we first started playing it. We started playing coffee here this summer, 2015. Is that right? Or was it last summer? Feels newer than that. So I think we might start playing it here anyway. Got a huge response. Maybe it was here, and maybe we got. I don't remember getting such a huge response right off the bat, but it was a great call. I think it might have been this year, and it was disappointing here. Then we played along again. It went flying up. Obviously, made a ton of money. Then it came back down, and we like it again. But the bottom line is, anytime it's down around here, where it is now, in the 120s, we love it. Because fundamentally, I think that's the bottom. I think even when demand is low and whatever, there's still a good bottom here at the 120 range. And there is no top. See, again, it goes to the risk-reward of playing something. If it goes down lower, I'll still buy it because, as our premise was 2 years ago, I remember it was a weather thing, and we said at the time it would take years to unfold. It still is. There's 2 problems. Global warming. Well, global warming is multiple problems. Coffee grows on mountains, but only between, you have a 2,000-foot mountain. It's not a mountain, 2,000, whatever, a 5,000-foot mountain. You have a 5,000-foot mountain, and coffee grows from 1,500 feet to 3,000 feet. It grows in a 1,500 band in the middle of that mountain at a certain climate, at a certain band of whatever. You can't grow it on any mountain. It has to be the exact temperature with the right humidity and the right distance. It's really sensitive. There's only 2 kinds of beans in the world. It's really Arabicas and Robustas, 2 strains. And there's one bug that eats them all. And now, global warming does a couple things. First of all, it messes up the arid area, and it takes 3 years to plant new crops. So even if the band changes, it changes, and even if you have a really, let's say it even goes to a fatter part of the mountain, it drives the band of the mountain down where you can grow coffee, and you now have more land where you can grow coffee than you had before. That's nice, but it takes 3 years before you can actually grow it. You got to plant those beans and wait 3 years in the right climate conditions. So that's problem number 1. Problem number 2, global warming causes drought sometimes, and sometimes it causes too much rain. Both of those things are no good for coffee. And it's true of many crops, but coffee is so sensitive, it's a tough crop. That's number 2. Number 3, the bug that eats the coffee plants is also climate sensitive, but it's climate sensitive to cold temperatures. And the longer the warm season is, like it was T-shirt weather in New York this weekend, it was 70 degrees in the daytime in November. That's scary. It really is scary. So meanwhile, I'm going around with a T-shirt and coffee bugs are out eating coffee. That's what's happening. So all these different possible things can at any moment completely screw up the global supply of coffee. And there doesn't seem to be anything interrupting the global demand for coffee. And you've got one of the biggest corporations on the planet, Starbucks, whose entire job in life is to promote coffee consumption. And you know how that works because there was a company called the Coca-Cola Company that promoted people drinking soda. And it was so good at it that everybody on the planet Earth now drinks soda, even though it's a stupid thing that you shouldn't drink. And there was a cigarette company once, Philip Morris, that promoted cigarettes. And not that many people smoked in the 1920s, and then for 40 years later, everybody on the planet smoked. That's what happens when corporations with billions of dollars get behind a marketing campaign and push things into the public spotlight. Doesn't matter if it's good for you. It doesn't matter if it's helping anyone or anything else like that. What matters is they can get people to do it. So that's where coffee is now. It's being actively promoted all over the world for you to consume more and more and more of it to make Starbucks rich. And there's lots of hangers-on, and they help too. They help Starbucks lose boys. As long as you drive people to drink coffee, there's a chance they'll eventually try Starbucks. So not that Starbucks wants all the competitors, but as long as they're getting people to drink coffee, that's cool. And it's weird because coffee's not bad. I mean, everybody kind of drinks coffee anyway, but the recreational drinking of coffee is a new kind of thing, especially the expensive coffee. But I mean, I don't even go to a hotel anymore that doesn't have a like one of those push button espresso machines or something like that. I mean, the regular coffee isn't enough to people anymore. So that's not going to change the demand picture. It's going to steadily increase most likely. Global warming doesn't change demand; it changes supply. So at some point, there will be a big drop in supply without a corresponding drop in demand, and this thing will do this. What happened here? And fly up. Now, if you happen to be long on coffee contracts and you catch a 100-point move at $100 a contract, that's $10,000 per contract gain. So, chance of losing $1,000 if it drops 10 points down to 15 to the next report. That's there. But if your plan is if it goes to 15, I'll double down and I'll be at 120 average. And if it goes all the way down here to 100 or 105 or whatever, and I'll double down again, I'll have a 115 average, which has been the base. And then I don't mind holding it for a couple of years. You have an incredibly good chance of getting that run. That's a big win. But what are you risking? Keep that in mind. If you start with one contract that can make $10,000, if it drops to 115, you add another contract. Now you have two contracts that are down 10 points, $5,000 between them, $2,500 each. Now, if it drops to 105 from 115, you would double down again. Your average was 120. Now your average is going to be 112 on 4 contracts, but you're still at 105, so you're down $750 per contract, $3,000. So your risk is $3,000, but your reward, especially if you have 4 contracts, let's keep it per contract. Your risk is $750 per contract doing it like that times 4 contracts if you want to scale in like that. But your reward is possibly having more than 1, 2, 3, 4 contracts at under 120 on a run back to 200. That's 80, so you're talking about $8,000 per contract. Up to 220 would be $10,000 per contract as a winner. So do we risk $3,000 to make $10,000 to $40,000? Well, sure, that's the whole point of investing, isn't it? It's not risk-free. There are risks. You could lose your $3,000. You could stop out below 100 with a $4,000 or $5,000 loss. If it goes below 100, you got to stop out if it goes below 100. Then something drastically is wrong. And I'm not saying you automatically double down. Anytime it drops, you want to find out why is it dropping, what happened. Because if your one contract drops to 115 and you decide to bail, you're down $1,000. That's not terrible. You can still make 10 on that one contract if all goes well. If all goes badly, at 115, you bail, that's $1,000. But then you would make a decision, do I want to double down, do I want to just hang on, so on and so forth. But all this is not complicated because we have a premise, and we'll know if the premise blows. And there was another article, there were 3 articles, there was one negative article on coffee. They are working on genetically modified crops that are going to have a higher temperature tolerance and better bug defenses or whatever the crap. And that will take them until 2022 to begin to plant them. But Starbucks is already experimenting with it. They're combination beans, and they're actually selling. They're experimenting to the point where they're actually selling them in their stores. They're growing them and selling them in their stores under their reserve umbrella. If you go to, there's some Starbucks stores have reserve sections, and that's got fancy coffee. So, and Starbucks is smart. They make these even though they totally talk about being how environmentally friendly they are, they make these genetically modified coffees, give it a new name, and then promote it as some special reserve. So they charge you more to test something for them. They have you they tell you double the money, and you go and try it and test it and so on and so forth. That's why they're brilliant, though. Great company. That's really funny, though, if you think about it. So you're the guinea pig for their genetically modified coffee. But the point being that means that should the tests go well and they begin planting it, they could have a decent amount of these beans going in the ground by like 2022. So our premise has a time limit because as we cross the 2020 threshold, it may be that the supply of genetically modified coffees becomes so abundant that it starts swamping the price curve. And don't forget, that's also something Starbucks wants. They want the price of coffee to be super cheap because their customers aren't going to suddenly, if coffee goes down to let's say this is $8 a pound, right? In the supermarket, I mean, that's what I pay anyway. So let's say it's $8 a pound for normal coffee in the supermarket. Starbucks customers aren't going to stop going to Starbucks because coffee goes to $6 a pound or $5 or $4 a pound. That doesn't change anybody's attitude about going to Starbucks. Like, well, I can make it at home. Because right now I think it might cost $0.25 to make a cup of coffee at home using a grinder and everything. So, those things cost about $0.25 if you're not using capsules. I mean, if you just take real coffee and put it in the grinder, each cup costs about $0.25, maybe 50 cents. So I'm not basing my decision on whether I go and get a nitro cascara latte, which I love, by the way. I'm not making my decision on whether I'm going to pay $5 or $6 for a nitro cascara latte on whether or not my cup of coffee at home is 50 cents or 40 cents or 30 cents. That's not why I'm going to Starbucks to get a nitro cascara latte. It's a different thing, a different experience. Going out for a coffee while I'm out, or when I'm in my car. I don't know. It's a weird thing. I mean, I don't drink that much coffee at home, but when I'm in my car, nothing I like more than a nice cup of coffee. From Starbucks. Just makes me happy. Also, if I'm in a hotel, again, I can't. In the morning, I don't drink coffee most of the time here. I'm a tea drinker, but when I'm in a hotel, man, I want a freaking Starbucks. Like a thing. It seems like it goes together in the morning. But anyhow, so point being, though, that Starbucks doesn't think they're going to lose business because the wholesale price of coffee goes down. But on the other hand, the price of coffee is one of their major input costs. So they could save billions of dollars. So they're very interested in coffee science and making cheaper beans and finding ways to grow better climate and so on and so forth. They love that. So those are the factors you have to consider in the context of making the bet. So I worry long term that they will improve bean technology and that there won't be these, and that the reason I'm investing now won't be valid in a few years. But meanwhile, we have a couple of years to still make this investment. So hopefully, cross our fingers, big global disaster caused by global warming destroys the coffee crops. That's what we're hoping for the payoff. And if we're lucky, we'll get one of these. If we don't get one of these, though, by the end of 2019, which sounds like the far future, but it's not anymore. But if in 2 years we don't get a nice spike like this, we're going to probably just give up. And then we look at a longer-term chart and see, well, wow, you can go quite a long time without getting a spike like that. So here's in 1997 there was one. In 2000 there was a nice move, not great though. 2005, that's 5 years, 3 years, 2 more years after that. 3 more years, almost 4 years after that. So, 4 years, I think you got a pretty good chance of getting a spike, but we just had a little spike, so we'll be kind of lucky to get the next one within the time frame we're looking for. And that's how you got to look at these trades. That's how you have to make those decisions. You have to think of the whole big picture tapestry of the thing before you start messing around with the short-term trades. What's on Restoration Hardware short-term? Can you sell 11/17/80 to 350, currently trading at 84? RH, did they not just disappoint? I thought they disappointed somewhat. I did not get a chance to look at their report. So I don't give you a half-assed answer. No, they're only up a teeny bit. I swear they reported today. RH. They unveil RH Toronto Gallery. That's RH. They repaid a second lien term loan. Pricey, where is Pricey shares? Oh, that's so cute there. They're so good at that stuff. That was a month ago. December 6th. No, I guess their earnings are like in an off time. So they blew up last earnings, and they're coming into the next earnings, and basically, obviously, expectations are high, but their business has been great too. So your question is, essentially, would you sell the 11/17s? Well, I wouldn't. If you're talking about selling the calls, I wouldn't bet against them. I mean, it doesn't make sense. You're saying sell the 11/17/80s. You're talking about puts, Naomi? The calls doesn't make sense. If they're at 84, the 11/17 $80 calls would be more than 350. Yeah, you're talking about the puts. I wouldn't. They're not. They won't have earnings yet, but unless you really, 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 really want to own them at net 70 whatever dollars. What did you say? The 80 puts? Yeah, those 80 puts are 3-something, 315 call it. So you're netting in for 77, 76, and 85, something like that. So what are the numbers on RH? Let's take a look. Oh, this is RH. They are at $1.8 billion, and they are dropping nothing to the bottom line. Is this annual? That's annual. Wow, that sucks. So the year that ended in January, they have weird quarters, only did $5 million in profit. They only did 90 million here, and let's see quarterly what they're looking at. Oh yay! Excuse me. They're flat right now. Yeah, that's a lot of money to pay. You're paying. You're not at. This is not 100 million in earnings. This is 10 million in earnings. They're not even a scratch. They seem kind of overpriced to me. I like them, but this is a lot of money to pay for something. That's why we always go with WSM instead of RH, because WSM is a much more. It caters to the same crowd, but they also have that Pottery Barn component to cater to poorer people, And other than that, though, they actually make money compared to these guys, which, they have a sexy business, but it doesn't make money. This says, I don't know where they're getting $3 a share. I can't imagine unless they don't have any shares. They've got 21 million shares, and I'm sorry, but there's some math here that's very wrong. All right, the float's 16 million shares. Look how much of that's controlled by insiders. 12% by insiders. 145% of their shares are held by institutions. That's a red flag. And 71% of the float is short. That is crazy. I can't reconcile this. I don't understand how they could be calling that money, which is millions, numbers are in thousands, millions, divided by 16 million shares. It's 30 cents a share, not $3 a share. I don't trust this. And that makes sense. PE ratio is 4,000. So anyway, so you're going back to your premise. You're saying should you sell puts? I wouldn't sell puts. I think that's too dangerous. I don't think this is a bargain. I think they're just a crazy stock with a ridiculous, unrealistic valuation, as are many stocks these days. And again, I like their business. I like the company. I love their stuff. But I don't see it. I don't see this kind of valuation being attached to this. It doesn't seem right. They've only got $2 billion in total sales. They're a $2 billion company. They've got $2 billion in total sales. Even if they made 10%, that'd be $200 million, and that would be great. And then they'd have a fair valuation. But they're not making 10%. They're not doing anything like 10%, and they have not shown the ability to make 10%. They're 5% at best, and that's $100 billion, and that would be a PE. $100 million, that would be a PE of 17, which would be reasonable. But they're not doing it. So, I think my problem with this is if I'm going to sell a put on a company, I have to really want to say I'll put my foot down at that price to own it. I can't see that. And not only that, though, but even if you go out to 2020, and let's say we sell, I don't think they have 2020. Oh, you do have 2020. Okay. So we go out to 2020, and even if I were to sell the $75, now this shows you what people really think of this company. You can sell the $75 put for $22. You can sell the $72.50 put for $20. You can sell the 60 put for $15. Okay, so forget your piddling $3 sale of the 85 of the 80 calls or whatever, of the 80 puts, whatever it is. Why, you can sell these things for 5 times that much money, and your net in would be $45. You sell these things for $15. Your net in is $45. That's like half of where it is now. That's how much people are shorting this stock. I mean, you can sell the 42.50 puts for almost $10. That's like saying they're going to go bankrupt. And again, because other people are betting that doesn't mean they're going to go bankrupt or whatever. But I don't see that valuation being justified in any way, shape, or form. So, I would condone this. I think that selling these 60 puts for $15, you've got enough of a cushion where you can work it out over time. But the other move is too aggressive. If for some reason they had such a bad event that they dropped 20% and you put in the money, do I really want to sit there and fight over it? Or, when they go back to 70, do I want to sit there for like a couple of years waiting to get my money back? No. It's not a stock I'd want to be in. I don't know. I want to find out where they're getting these earnings numbers from. They're weird. But even here, it's showing earnings, 70 cents a share, earnings, 65 a share. So, what we say, 16 million shares times 0.65, that's $10 million. get another look and see if that's realistic. Well, quarterly? I mean, well, I don't know where they get that number. There's no profit here. There's no profit here. So there's some financial engineering going on just to get into where they are now. But yeah, that low share count explains why you can have this. They don't seem to make any money. But apparently, whatever money they do manage to push onto their books shows up as a really nice profit because the whole company, it's almost privately held and very thinly traded in that case, right? That's your trading volume. 1.5 million? No, come on. 10%? 10% of their shares turn over daily? Good God. This is a weird company. I don't think I want to play with it. That's why we don't, frankly. They were really cheap once and we used to buy them, but then they got expensive and we completely lost interest. I think they've been massive buyback. I would say so. Something weird is going on with these guys. It's very interesting, but it's crazy. Let's see. Cash flow, statistics, financial, cash flow. Well, here, 55 million, but it's not that much out of a couple $1 billion company. It's a lot, but it's not incredible. Look at the money they're borrowing there, too. Oof. Changing cash, 244 million flushed out. Balance sheet. Look at that. They went from 331 million last year to 87 million now. They have a 21 million. Look how they're burning cash. So in other words, they had 331 million, which they accumulated because they borrowed a ton of money. They have dropped to 87 million last year through January 28th. And on a quarterly basis, basically this quarter until July, they dropped $60 million. So of course they got to raise some cash. They can't go on like that. So where's the thing that says they're raising cash? RH unveils, RH Interiors, Investor Day. They repaid a loan. Well, I mean, that's where the cash is going. Strong estimate revisions, They got to raise some money. So if they raise some money and the stock drops, that's when you want to do it. But I don't think they can keep going with that kind of a low cash, but with that low amount of cash. It seems a little scary to me. All right. Oh, we can check the petroleum status report and see if they've ever updated it. Week. Nope, still October 27th. How annoying. I'm not happy about that. How's our bounces going? Any luck? Ooh, see, we got a little bounce there, and we got a little bounce here. Nothing so exciting, but at least it was something. And what happened here? Did the Russell start catching up? Not particularly. Oh, because he's not over. See, that's not over our line. That's at our line. And he's over the line. So if the Dow confirms, it still goes long on the Russell. I think we were a bit lower. Weren't we like 1475 or something? So it is going up. But again, I'm looking for a play. I wouldn't, ordinarily it would be something I just basically ignore because it's not that interesting. There's no compelling reason I want to be long on the Russell. Nothing in the news that I saw that makes me think it. Now here we got the bounces we were looking for, so let's talk about that, strong and weak bounces. So for oil, it goes from 57.75, we'll ignore this, so from 57.75 down to 56.50. Even though it didn't actually hit it, we'll still say that's where it stopped. We'll probably exactly hit it. So that's, let's see, $1.25. So if it's $1.25, that means the bounce is going to be 20% of $1.25 is 25 cents. Oh, how nice. So 56.75 would be a weak bounce, and 57 would be a strong bounce, and that's exactly what we got here. So we have weak bounce, consolidate, strong bounce, fail, weak bounce, consolidating again. So if we're not moving back up from here to retest the strong bounce, then probably the weak bounce is going to fail, and we're going to go back to retest 56.50. Now in gasoline, I'm going to get a headache trying to figure that one out. Let's see. Basically, 180 to 184. So that's 2 cents, and that means 0.4 is going to be a weak bounce. So 0.4 cents. So to 04, is that right? 1804 here is a weak bounce, and zipped right over that, and then 180. Oh, I'm sorry. I'm sorry. 0.4 above. I did that totally wrong. 184 to 181 is 3. So your 06 is your bounces. So it would be 181.06 or 181. Yeah, 181.6. That's a weak bounce, and then 12. So the next level, 2.2. That's your strong bounce. So it's the same thing. You can see how the 5% rule works. So had we been following it the whole time, we could have easily said, well, at the strong bounce line, we can retake a short and see what happens. And now, in fact, we are failing the line on gasoline. And if we're failing on gasoline, which had a draw, then there's no reason to think we're going to hold the line on oil at 56.75. So that becomes now my favorite short if gasoline does fail to hold this line. But we will see what happens. And so when I'm doing this, if I'm watching the charts, I would then go to trade, active trader, and make sure I've got the things I'm going to trade set up, and I do. And I'll take out the Z on this one. This is RB. And that's what we're watching. We're watching the Russell to get over this line. And the thing that we care about the most is the S&P. Getting over their line at 25.90. In other words, if he breaks down, then he becomes a good short. But if he pops up, then he becomes a good long. And we know the NYMEX is closing in 20 minutes or in 30 minutes. So there's going to be some kind of big move one way or the other. Still have plenty of time before these contracts roll over. That's not going to be an issue. But there are a lot of contracts, a very fat amount of contracts. So there's plenty of money to lose on this thing. So I'm watching this line very closely, the previous low. If that line fails, I'd love to grab this guy. I'd love to grab this guy for a short. So let's call it 1807. And the S&P is coming back down. So it looks like there's some weakness here. I want to now check the dollar and see how it's looking. And the dollar is not doing anything, so you can't blame the dollar for any of this. It's just these indexes are sort of selling off from their peaks. Everything's kind of pulling back a little bit. I think somebody's just getting some more cash out of the market. That's what it looks like to me. But nothing definitive, so not really worth staring at. Oops, where's it? Good. All right, so what else has been going on? I was away for 2 days, so I'm kind of haven't had a lot of trade ideas for it. Very particularly, although we actually talked about a couple of things today. Let's see. Catch you guys up. So TZA we talked about as a hedge, the April 13-17 full call spread with TZA at 14 already. So you're in the money. You're paying $1 or 95 cents for the spread, and you've got all the upside up to 17. So you can make 300% above 17 on the spread. It's nice coverage. You don't have to do anything else. The only way you can lose money is if TCA goes lower, which means the Russell went higher, which hopefully if you're balancing out your portfolio means you're making more money than you're losing. Now, on the other hand, though, the 2019 15-25 spread, and remember this is our target, this line here, the 15-25 spread, or a net of 130, would go about 250 in the money here on a move like that, but of course a bigger move, another 3-4 points, and you'd be deeply in the money, like in the 20s. You won't really get paid because all you're going to get paid is the delta of the two positions. So you won't make quite as much money as you think you're going to make on the spread. But the point is, if the Russell goes down and stays down at the end of the year, you're going to get plenty of money to buy more positions. If it goes down and comes right back up, the spread will end up being worth not much more than it was. But since you're having in the money a near the money position, you'll profit from the decay here. But the main point, the reason I like this spread isn't so much because the spread's going to make money or be better. It's not better than the April spread. But what it is it's $1.30 outside spread that you can easily sell puts and calls against. So at $1.30, if you sell 1/2 of the spread, so you buy 10 of these and sell 5 of these, and you sell half of the January 17 calls for 42 cents, you're picking up 42 divided by 2, so you've got a half hedge, so you're picking up 21 cents per long. That's 15% of the value of the long in just 1 quarter in a 2-month sale. So if you make 6 more sales like that, you're going to get back almost the entirety of your insurance hedge, which makes for eventually free insurance. That's always a good way to play. That's a nice way to hedge. So it's about GNC and how we still like it. Still seems all right, even though it's getting beaten up. We talked about the oil stuff. Yes, Vertex went up, but nothing too exciting so far. Seadrill didn't go bankrupt yet, which is very surprising. We had Seadrill. We owned them, and we got out when they started failing, like $2 in the $2 range. We decided to quit because we didn't want to ride them out through the bankruptcy. But now they're kind of interesting down here, considering they aren't actually out of business yet. We talked about Sears really getting hammered, and then we talked about Macy's and stuff. I'm not sure where that is. Oh, Snap. Snap's doing terribly. By the way, it's one of the things that can take down the market is Snap. Oh, wait a minute. Are they back up? That'd be weird. No, it's still down 17%. I was going to say it seems odd. So Snap is hurting the market in several ways. It's hurting all the overpriced IPO stocks that have 100 times multiples. Because you look at Snap and say, well, that sucks. There's $1 billion unicorn stock that died. And it's also hurting the unicorns that want to IPO. Because this is a scary loss, and nobody wants to be involved in something like that. Fossil had a horrific loss. They went flying lower. Apple's being Apple. In fact, that's holding up the market today. So Apple's doing well. Especially if it is. It's actually back to like flat now. And we talked about a Tesla trade, but that's done with basically. Best Buy, I still like them. They're stupidly cheap. This is the adjustments we made in the portfolio review, which is right at the top of the page. We have a tab for that stuff. Here's GIS, and we still like them. We think they bottomed it out here. That's a good trade here. GME, let's see. This is GameStop. And GameStop, I pointed out, look at Take-Two. That's the game company. Through the roof. GameStop, going the exact opposite direction. They sell what these guys are selling. So it just seems it seems overdone to me. So I really like GameStop down here for sure. And let me talk about Macy's, which I like too. And that's where we are, all right? So not much else to talk about today. It was pretty easy. These don't look good enough for a place. I'm sorry, there's nothing exciting to play right now. So we're going to call it a day, and we'll just look for some more setups. But it's kind of a lazy week. There's not much news. There's nothing going on. The Fed's not speaking. Next week's going to be a lot more exciting. But unfortunately today, we're just sort of like watching things develop and seeing what happens. We're watching the last big week of earnings come in. After this week, though, by the way, I get a lot more interested in playing earnings because we have enough data. I'll be sitting there reading it this weekend. We have enough data to sort of like extrapolate, like, well, here's a company coming in with earnings, and then therefore we've seen like a burger chain. So like maybe Burger King reports late or something like that. I don't know when they report. But then I say, well, Red Robin had terrible earnings, and McDonald's had good earnings, and this one had bad earnings. And you can start putting together a picture to say, okay, well, in that case, given the kind of restaurant they are and where they lie in the spectrum, here's where we think their earnings will come out. And that's very useful for trading because it makes some nice, fun, short-term trades. So we're probably going to do a few of those next week and the week after that as the last of the earnings trickle in, and we've got a pretty good background on where things are. So hopefully that'll be good for everybody. We'll talk about that next week for sure. All right, any last-minute questions? No? Everybody's happy? All right, fantastic. Well, it's been fun, and we'll do it again next week, all right? Take care, everybody.